Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to another live stream. Today, I'm going to talk about why you need to be getting prepared for a major inflationary crisis. And today, we are actually being presented with an opportunity to get better prepared. Now, what do I mean by that? Well, the price of silver today coming under some pressure. Slight sell-off, down about just under 50 cents. It's down a little bit lower on the very lows of the day. And, we talked about this when we saw silver blowing through $30, through 31, through 32 recently. Saw it breaking out from resistance at $30 that has been present for more than a decade. We discussed how nothing moves up in a straight line. Okay, you've got to have some of these consolidations, some of these pullbacks on the run up. And I look at them as a huge, huge buying opportunity because now the breakout is all but confirmed. We are heading to new all-time highs in the metals, if you ask me. And I want to talk about what's driving the price of silver and gold to sell off today because it's very telling. We're not being told the truth by the elites, by the folks in charge, by the central bankers, and that is exactly what is driving the price down today. Before we get into that, do just want to mention, if you want to get your hands on some gold or some silver to get prepared for the coming inflationary crisis, which, it's not financial advice, but I see one coming. I see one on the horizon. Make sure you check out SD Bullion, today's video sponsor. That's why I buy my gold and silver. You can see I don't even take all my junk silver out of the wrappers anymore because, it's actually just neater to keep it organized that way. But that's where I buy my gold and silver. So check them out with the link down in the description. So what drove the price down? At least one of the factors that seems to be contributing to lower gold and silver prices today is all of these Fed officials jawboning the market lower. And if you ask me, this is intentional. So here's a piece from Reuters. Fed officials urge patience on timing of initial rate cuts. So, markets are still focusing on when the Federal Reserve is going to cut rates. The only thing driving action in these markets, or the only thing that the algorithmic trading bots and the Wall Street traders seem to pay attention to, when is the easy money coming back, right? When is the Fed going to cut rates? And I think that ultimately that's not going to matter for the price of gold and silver and for these markets and for the dollar. But in the short term, certainly it can have an impact. And we had these Federal Reserve policymakers on Tuesday, multiple policymakers telling us that, we're going to have to wait longer for rate cuts. Yes, hello. Everybody in the chat who's joining in, I see you in the chat there. Hello, welcome. Do me a favor, smash that like button, help get this information out there, because the more people who get prepared for what is coming, the better off we're all going to be. But here's some quotes. We had Christopher Waller, Fed governor. He says, in the absence of significant weakening in the labor market, I need to see several more months of good inflation data before I would be comfortable supporting an easing in the stance of monetary policy. You had Loretta Mester, that's the Cleveland Fed president. She said at a conference, I need to see a few more months of inflation data that looks like it is coming down. Boston Fed President Susan Collins said, we're in a period where patience really matters. I think the data has been very mixed and it's going to take longer than I had previously thought. Now, look, the Fed, these officials, they don't make these statements by accident, right? Everything that they put out is a calculated statement because they know that the algorithmic trading bots, the traders, market participants hang on their every word. Now, why do they do that? Well, it's because our entire economy is predicated on easy money from the Federal Reserve, right? That is the whole basis of the bubble economy in which we exist. The economy where huge levels of debt have inflated asset prices to unbelievably sky-high levels. Gold and silver, honestly, some of the few assets that have not been blown into enormous bubbles by all of this borrowing, all of this debt monetization, all of these artificially low interest rates that we've been witnessing for, a decade plus. And the Fed officials, they know that markets listen to this. So why would they make this statement? Well, part of it, undoubtedly, is the fact that you've got gold breaking out to new record all-time highs. Why is that occurring? Well, central banks around the world are loading up on this stuff. And it's only a matter of time before retail participants, before investors begin to understand what is ahead in terms of debasement of fiat currency. And the Fed, their job is to instill confidence in that very fiat currency. And, when you see gold prices breaking out, when you see silver hitting the highest prices in over a decade, clearly that psyop of, supporting fiat currencies is in danger. And what have we witnessed in regards to the dollar? Well, you can take a look at the US dollar index. You can see as gold and silver have been breaking out, it has been falling, right? It is like the inverse of the metals most of the time. Because when you see fiat currency weaken, you see commodities like gold and silver and other commodities too. It's not just gold and silver that have been moving higher. I mean, platinum, still incredibly cheap, but it's been moving higher. You've got copper, which has been hitting new all-time record highs along with gold. So, the bidding up of commodities, a lot of it has to do with a lack of confidence in the dollar, with the idea of, very easy monetary policy moving forward, rate cuts, a return to QE. The Fed has already begun to slow down QT soon. They're going to have to get back to QE. That's just the reality of it. But their job is to support the dollar. And, look, their job, I don't think, is to defend the dollar in the long run. Obviously, they tell us the objective is to devalue it by 2% annually. But in the short term, they've got to try to prop this stuff up because it's like any crisis, right? You're going to be the last to know about it. Their job is not to inform people about how bad the situation is, because if they did, there would be pandemonium in the streets. That's how bad the economy is. All you have to do to see that is just look at the U.S. national debt, right? $34.7 trillion. I mean, it's unpayable, right? The reality is we're in a lot of trouble. But look at what happened with the U.S. dollar index following those comments from the Federal Reserve, right? Begun to tick back up. A little bit of confidence being instilled in this fiat currency because the Fed out there jawboning the market. So look, this dip, I think, is a huge buying opportunity to get ready for what is ahead. And you can do that with any form of precious metals. We've got some junk silver out here on the table today. I think this is some of the best stuff you can get. In an inflationary crisis in which the world reserve currency is being devalued, you're going to want some hard assets. And of all the things you're looking at here right now in terms of bullion, junk silver is one that has actually served as a means of exchange for a very long time, right? I mean, when this stuff was being minted, it actually was the circulating coinage of the land. I've also got some gold backs out here. Look, if you want something that's going to serve as a unit of account, as a unit of exchange in the absence of fiat currency, I think goldbacks are something you want to examine, right? A lot of people out there say, well, they're too expensive, the premiums are too high. The reality is that with goldbacks, I think that people are resistant to change. They're resistant to new things. They don't, trust the technology for whatever reason. I think the silver and gold stackers out there are kind of a bit of a stodgy bunch in some ways. We tend to be a little bit more conservative with how we view things. We don't trust fiat. Maybe we don't trust new technologies either. But these things, if you're using precious metals as a means of exchange, these are going to be very helpful. I mean, traditional bullion too, right? 1 ounce gold coins, 1 ounce gold bars, as I mentioned, platinum. I mean, any of these things that are of real tangible value, real commodities, tangible things that can't be just, printed out of thin air. That's what you're going to want to have in the coming crisis. I want to delve into that a little bit too. We've got some other stuff to show you here, but look, when things start to fall apart, I talk about, wanting to have gold and silver, and I get a lot of pushback from some of the more preparedness-minded viewers out there, because there's a lot of reasons we stack gold and silver, right? One is to have a savings account that is outside of the digital financial system. One is because they're very undervalued, right? So if you approach things from a value investing standpoint, gold and silver are just really cheap right now, and there's not too many assets that are cheap. We may expect to trade into other hard assets at some point, or other, various assets, say when ratios become more favorable. Maybe the Dow to gold ratio may revert to the 1-to-1 ratio or 2-to-1 ratio that we've seen historically, because right now it's like 17-to-1. So, you buy an ounce of gold now, you wait until that ratio comes back, you sell your gold, you get into some paper stocks when they're cheap, and you can do pretty well. But a big reason for stacking, especially the junk silver and things like goldbacks, is because we don't really know what things could look like in the event that we face a major financial crisis, a major debt crisis, a major currency crisis in the West. And, again, that may sound like it is, in the realm of fiction, in the realm of fantasy, but the numbers don't corroborate that view, right? $34.758 trillion now on the national debt, the unfunded liabilities. You talk about all the stuff that the federal government is on the hook for, $215 trillion. You can just do a little basic arithmetic here and see that there's no way that's ever going to be paid in anything other than massively devalued currency. And, I'll talk about how you want to have some gold backs on hand in case you need to use physical currency. Each one of these notes is 1/1000th of an ounce of gold. And people will tell me, well, you should just stock up on food instead of worthless metals. And yeah, you should have food for sure. But I don't know about you. I don't have a gigantic warehouse that I can fill up with food. Food takes up a lot of space. And yeah, you should have some, certainly. But if you want a compact store of wealth, maybe you've got all the food you can get. Or, people talk about having self-defense items, brass, lead, that kind of thing. And yeah, you should have that too, for sure. But, when the time comes and you inevitably need something that, you didn't think of or that maybe you didn't need before, but now you need, there's always going to be some kind of a functional economy, no matter how bad things get. You got to understand that. I mean, in Venezuela, in the depths of their hyperinflation, when it was certainly an SHTF scenario, I mean, I know a number of people personally who lived through the worst of the hyperinflation in Venezuela. We're talking, adding lots of zeros to the end of their currency and a lot of aspects of society breaking down, the grid breaking down, water deliveries breaking down, food deliveries breaking down. There was always a black market. There was always trade, a significant amount, right? If you needed antibiotics, you couldn't go to the hospital because there weren't any. But you might be able to find some if you had something of value to trade on the black market. Now, I will say this. In Venezuela, during the heights of the hyperinflation, there was not a lot of exchange going on with gold and silver. I'm sure there was some, right? There probably were some people trading with physical metals. There probably were some people trading with food. There probably were some people using cryptocurrency, but the vast majority of the trades in the Venezuelan black market during their hyperinflation was being conducted actually in US dollars. I know this from speaking to a number of people who lived through it, at least, in their experience. What you would do is if you had some gold or silver, and some of them did, they would take it to a dealer, somebody, again, this is all on the black market, who traded in gold and silver. You would swap out the metals for US dollars, and then you would use the US dollars to go and exchange things, okay? Now, keep that in mind. But here's the thing to think about. If the US dollar, the world reserve currency, is the fiat currency that is hyperinflating or being devalued dramatically, there is no other fiat currency that is going to be able to swap in and substitute for that. I mean, people talk sometimes when I'll mention de-dollarization and they say, oh, are you saying I should go out and buy rubles or yuan? It's no, don't do that. Maybe you should buy what the BRICS nations, the de-dollarizing nations' central banks are buying, right? Which is gold and, probably some silver too. We talked about that in a recent video about how in the Shanghai Gold Exchange, silver's getting bid way up. Why is that the case? Well, they're loading up on physical assets. But yeah, I mean, if you see the dollar hyperinflating, if we have a debt and currency crisis in the United States where we have the world reserve currency, that's probably going to spell the end for all of the major fiat currencies around the world. And then what do we go to? Well, it's hard assets. Yankee stacking, he says, no other country's fiat currency economy compares to the reserve currency dollar collapse. None. This will be totally unprecedented and insane. Yeah, it's true. And, never before, I don't think, have we been as dependent on the global financial system, a digital global financial system. Never before have so many people lived in cities. Never before have people transacted with electronic money on a scale like we have. Never before have debts and derivatives expanded to the level that they currently exist at. Never before has a global reserve currency holder exported so much funny money, inflation, and debt around the globe as in the scenario that we now find ourselves in, right? So the bottom line is that when you're thinking of the price of these metals in dollar terms, I mean, it doesn't really even make a lot of sense because there's so much debt and so many dollars around the world. If all of that floods back into the US, let's say an event takes place which triggers that, right? A major financial crisis in the US, right? Higher rates are likely to lead to that. If the Fed doesn't cut rates, we're going to see banks begin to fail. That could cause a cascading financial crisis that the FDIC have to step in and insure all of these deposits. I mean, they're going to have to run the printing presses like you wouldn't believe. That could cause foreign nations to dump their US Treasury holdings. Now, look, I mean, this is all just speculation. This is all just a hypothetical scenario, but the one thing that is not hypothetical is that the current situation has become incredibly fragile. It has lost its resiliency. That's why every time we get a crisis, they have to print more and more money. Look at the amount of debt that was monetized back in 2008. First, it started off with the $700 billion or something like that, the emergency rescue package. Then you get QE1, QE2, QE infinity. Then you have a pandemic. There's always going to be some shock to the system, right? And the answer has been to print more and more fiat currency along the way. And all this time, they've been running these massive deficits. We've got deficits at levels completely unimaginable in years past, right? It's like a $2 trillion plus now annual deficit. It took more than 200 years to rack up the first $1 trillion in debt. Now, every 6 months we're doing it. Clearly, we're reaching the end phase here of this experiment. And, it might not be tomorrow, might not be next year, but mathematically, it seems to be an inevitability. I mean, perhaps there's a possibility that the elites could balance the budget, impose austerity, slash unnecessary programs, have this return to fiscal responsibility. But let me know what you think the odds of that are in the chat. Put a 2 if you don't think that there is a snowball's chance in hell that that's going to be the case, because that's how I feel, right? The way I see things playing out, there is no way that we are going to witness a return to fiscal responsibility. And so the alternative is that we witness the destruction of the currency. You have two choices here, really. I mean, when you have debts and deficits on this scale, there is no way that you are going to get a return to anything normal. No, things are going to get worse. And, maybe we can do one more bailout. Maybe we can do 2 more bailouts. I don't know. I think that the next bailout is going to be the final death knell for the dollar. I mean, that's just my personal take on it, but I think that very well could be how it goes. Someone here says, Anxious Stacker says, absolutely not on stacking gold backs. You might as well be getting 10th and quarter ounce coins if you're going to pay that much on a premium. Just buy silver. Yeah, well, I can kind of understand what you're saying there about the premiums on the gold backs. The difference, though, let me touch on that real quick, because this is a common misconception, I think, about gold backs. So let's say I don't have any 1/10 ounce gold coin. Actually, yeah, I do. I have a small fractional gold coin here. Hold on. Okay, so here's a 1/4 ounce gold coin. If you go to a bullion dealer, and these are different coins, this is like a Perth Mint coin, this is Britannia, but let's just say, disregard that difference. We're just talking about a 1 ounce gold coin versus a 1/4 ounce gold coin. You're going to pay more per ounce when you buy this coin, right? The reason that premiums are higher on smaller bullion products is because it's going to cost the mint the same to mint this coin as it costs to mint this. So if you're minting 4 of these, it's more expensive than minting a single 1 ounce coin. And it's pretty easy to understand this concept. However, when you go to sell your 1/4 ounce gold coin, it's very likely that whatever market maker you're going through, a bullion dealer, a refiner, whatever, they're probably going to pay you spot, right? Maybe they pay you spot for this, maybe they pay you spot for that. You paid a higher premium for the 1/4 ounce gold coin. That is a problem, right? Because now you are losing the additional premium that you paid. It's not really the case for gold backs, okay? Yes, you pay about 2x the spot price of gold. Each one of these is 1/1000th of an ounce of gold. So, I mean, if you're paying a premium for a quarter ounce of gold, I think it makes sense that you pay a higher premium for a 1/1000th ounce of gold note. But the thing is that when you go to sell that gold back note, you're going to get that premium back. The spread, meaning the difference between what you pay for and what you get when you sell a gold back, if you're doing it the right way, is incredibly narrow. In most cases, it's less than 5%. Some dealers even have a zero spread offer. So look, I buy my gold and silver at sdbullion.com. If you want to go there, they do sell goldbacks, but you might want to take a look at this place, Alpine Gold Exchange. Now, I buy goldbacks here sometimes because the way that they price their goldbacks is they don't price them like a traditional gold product, right? It's not like they have these larger notes with a lower premium and then the one goldback notes for a higher premium. No, they price these as a one goldback note, $4.74. Boy, that's gone up a lot, right? With gold. You get a 10 goldback note for $47.40. And you can, they have a thing called the UPMA where you can go in there and you can actually get storage of your gold backs. They will buy them back at the exact same price that they sell them for. So the whole premium thing on gold backs, I think people freak out because they do have a high premium, but you got to understand there's a very liquid secondary market for these. You can just go on eBay and look for completed gold back sales, and you will see that you're going to get that premium back when you sell them. It's actually better than with smaller fraction gold products. I try to actually stay away from like the 1/10th ounce gold products. Now, quarter ounce maybe. I think this was on sale at SD Bullion when I bought it. It had a pretty good premium. But generally, I like to stick to the 1 ounce gold products if you're just interested in getting the most weight for your money. I mean, heck, if you really want to avoid premiums, go get a kilo gold bar, right? But that's not really the best preparation in terms of, you know, an SHTF thing, because how are you going to spend that? I mean, maybe if you're buying a house or a castle or, you know, a bunch of cars or something. But, you know, for SHTF, I like the smaller denomination stuff. For me, I like to go with junk silver and goldbacks. That is my preparation really for the potential need for a unit of exchange. I don't ever plan on selling my goldbacks, really. I don't ever plan on selling my junk silver. This is what I am holding in, you know, a core position of a means of exchange in the event that the currency falls apart. Now, 1 ounce gold coins, yeah, maybe I'll sell those sometime. If they go up a lot in fiat terms and I want to buy something for my fiat, yeah, you can sell your 1 ounce gold coin, you know, your weightier gold bars, silver bars, large silver rounds. Those are great. Those are more of an investment to me. But this stuff is more of a preparation. And, you know, you can think about it like this. Every dollar of junk silver that you're holding, you know, that's another day you can buy food. That's another gallon of gas you can put in your gas tank in the event that the currency hyperinflates. So when you see days like today, where you've got this pullback in silver. Now, mind you, this is not a major pullback. This is, to me, just a slight consolidation before we continue to see a run higher. I view it as a significant buying opportunity. I wanted to look at the chart of silver, actually. So I've got it pulled up on TradingView here. And you can see, I mean, well, I thought I had it pulled up here. Sometimes a tablet can be tough. It doesn't matter. We don't have to look at a visual representation, or we can. I got it pulled back up. Man, sorry. That's the beauty of live streams, right? Anyway, look, the deal is that silver had a huge breakout past $30. There was a lot of resistance there. It had been touching that price. Let's see if third time's the charm here. Okay, so here's the silver chart. I mean, it absolutely blew through 30 bucks. Look at that candle. Went up to $31, $32 in a very short period of time. It's completely normal to see a pullback here. And those hawkish Fed comments we talked about earlier is, you know, a nice little catalyst for a consolidation here. But as long as silver stays above $30, it's actually very bullish that we come down, retest that level where there used to be this huge resistance. Silver blew through it. Now that's going to become support, and we're just getting ready for the next run in this move. Yeah, Robert Lane says silver will be unattainable. Well, there very well could be a phase. You know, if we see some kind of a crisis, like say a collapse in the banking system or a major war breakout, it could be a repeat of March of 2023. Remember how things went when Silicon Valley Bank started to collapse. They started that collapse in the regional banking sector. It was you'd go to your dealer and you'd have to wait a month to receive your gold or silver. Remember, SD Bullion had to implement a $500 minimum order because they were getting inundated with so many orders. All of a sudden, everybody wants physical metal when a crisis breaks out. You want to get your hands on metal now, before that happens, right? When everybody is relatively non-enthusiastic about the metals. I mean, look, silver just broke out at the highest price level in over a decade. And what's everybody talking about? Oh, Bitcoin's moving back up again. Gold is taking out, new all-time highs seemingly day after day. I mean, we got a little bit of a pullback today, of course, but who's talking about it? I mean, very few in the mainstream. So that's why premiums on junk silver are still very reasonable, even though, you're going to pay more because the spot price has gone up. When you start to see premiums on this stuff explode, that's when it will indeed become unobtainable. So that's something you want to keep an eye out for. I wanted to delve into this as well, and this kind of corroborates what I was mentioning earlier regarding silver holding that $30 level, and the fact that we're just consolidating above that level now indicates that we're getting ready for another major breakout, which I do believe is coming. Before we get any kind of a hyperinflationary collapse or a major disaster, I think the price of the metals, in the very short term, is probably about to be moving much higher. And the analyst from TD Securities, according to this headline, sees that as well. Silver eyes $50. TD Securities predicts major breakout after $31 support holds, which is what we're witnessing right now. And there was a note that was published Tuesday from commodity analysts at TD Securities reiterating their bullish outlook for silver as physical demand continues to outstrip supply. And that's a fact. There has been a deficit in the silver market for several years now. Last year, it was to the tune of well over 100 million ounces, meaning that much more was consumed by industry than what was produced by both mining and recycling. So the amount of available physical metal is shrinking. And in his latest note, Daniel Gowley, senior commodity strategist at the Canadian Bank, said he is keeping an eye on the white metal's all-time highs. That gives us an idea of where it might be heading next. The last time silver prices broke through $30 an ounce, it traded to $50 an ounce in less than 10 weeks. So think about that. I mean, that means that before this election occurs, if silver follows the trajectory that it took in 2011, after it broke out, I mean, it was to $50 in a very short period of time. So this pullback and I don't mean to try to instill FOMO or use these, annoying high pressure selling tactics or anything, but if you just look at history, when silver gets moving, it really can move fast. And this pullback that we're seeing today, it is possible that this may be the last pullback to this price level, at least, before we hit new all-time record highs in silver. I mean, I'm not saying it's going to shoot straight up to $50 with zero pullbacks along the way, but if it hits 40 and then goes to 35 and then hits 45 and then, back down to 40 and then back up to 50, if it does something like that, and this is all, of course, speculation, I don't know exactly how the price movements are going to take place, but if we head to $50, it could be very quick. Within a matter of, 2.5 months, if we just take the historical example. So what does that mean? That means that by the end of the summer, we could be looking at $50 silver. So I think today is a huge opportunity for those of you who maybe were watching this breakout in the price of silver and kicking yourself saying, man, I wish I had bought in earlier. I wish I had bought when the price was at $25 an ounce or, $23 an ounce. And I know many of you watching, if you've been watching this channel and you've been, taking this information to heart, you probably were buying back then. I know I was. Of course, I don't tell anybody what to do with their money. You got to do your own due diligence, but I've been loading up on silver and pointing out that those ridiculously low prices were a huge buying opportunity for, a year now, right? You've been watching, I hope that you took that information to heart and, made the right decision and got into some hard assets. But maybe that's not for you. If you got a bunch of high interest rate debt or something, pay that off first. Don't go out and buy a bunch of gold and silver. Again, not financial advice. And people sometimes say, "Okay, smart silver stacker, we get it. It's not financial advice." Well, look, I got to say it because we live in an incredibly litigious society, and I don't want some guy coming and saying, "Oh, went out and mortgaged my house and bought a bunch of short-term options on the price of silver because I watched your video and I lost everything, and now you owe me." So, look, if you wonder why I say that stuff, I mean that's why, right? Because we live in a clown world, and you got a CYA. But look, this again is a buying opportunity. If you don't have any gold or silver, you might think of establishing like a core position. And a lot of times people will ask me, how much gold or silver should I own? And I mean, it's not really a question I can answer without, sitting down with you and understanding your situation. And even then, I'm not a financial advisor, so I couldn't tell you. But I think it is a good goal to maybe set an amount for a core holding, like something you never intend to sell. You just keep it just in case, the currency collapses and we experience hyperinflation and you need some hard assets. Maybe, I don't know, 500 gold backs and $100 face value of junk silver. I mean, that's like the equivalent of 2 ounces of gold in terms of price. So I think it's a reasonable target for a lot of stackers. And that might be just kind of a baseline number to think about when it comes to having a core holding. Like, how many hard assets do you need to get you through a hyperinflationary collapse? Yeah, River Pike says 10% of portfolio. That's, I guess, the traditional wisdom. I will tell you, I probably have a lot more exposure than that personally. And, this year, I'm not really regretting that, given that silver's up something like 30% thus far year to date, and gold over 20%. But yeah, the traditional wisdom is like 10%. But I think you need to have some core holding of physical metal, because that's what's going to be able to get you through a period of significant economic decline. And look, it doesn't have to be junk silver or goldbacks. That's just my pick. I mean, it could be anything physical. You could go out and you could get yourself some old copper pennies. Pre 1982 pennies, that's a good thing to hold, I think. You can get yourself U.S. nickel coins. Those have gone up to way over their face value. And to me, you can still buy those at face value. That's like a completely safe bet, right? Because it's always going to be worth 5 cents, and you can get them for 5 cents, and yet the amount of metal they have in them is like way over that amount. So, look, how much gold and silver should you have? I threw out some ideas earlier in this video. I hope that's helpful. I hope all of you are getting prepared, because while an absolute collapse of the US dollar, a major hyperinflationary crisis, is still probably a fairly low probability event, at least in the short term, it's higher than it was, right? And climbing, unfortunately. And even the political elites, the central bankers, I mean, they acknowledge that we are on an unsustainable fiscal path here, and that should be obvious to anybody who can just do basic arithmetic. So I think it's wise to get prepared. And sure, you need other things too. You need food, you need ways to protect yourself, you need water, all that stuff. But that's not what we're talking about today. We're talking about, financial preparedness and having a means of exchange when SHTF occurs. So let me know what you think in the comments down below. Stay safe and happy stacking, everybody. I will catch you next time. Smart Silver Stacker out.